A very good morning to all of you, and in this module we will be covering certain aspects of international taxation. International taxation is basically a developing field and it is gaining a lot of importance for tax collection by any government. And every day you will find that there are new concepts being developed in the field of international taxation. We will try to cover today some of these major concepts which have evolved over a period of time. First thing we will start with is the principle of double taxation. Under taxation we have a concept called a nexus theory. Nexus theory basically says that any government can levy a tax only when they have some sort of a nexus either with the person who is being taxed or with the income that is being taxed. We cannot levy a tax in vacuum. So therefore, as you would have studied, we classify assessees into different categories. Some are non-residents, some are residents, some are not ordinary residents, and we also classify the income depending upon where I earn the income, what is my source, where did I earn it. So we see where is the income earned. For example, we say income earned in India, income deemed to be earned in India. So the Indian government can levy a tax only when they establish a nexus either with the person or with the income. Therefore, a person who is resident of India becomes liable to pay tax in India on his global income. Wherever he might earn the income, wherever he might receive the income, he has to pay tax on that income in India because he is a resident of India. Come to another case now. Say I am talking about a person who is a citizen of America, a resident of America. Can the Indian government tax that person? No, because we do not have a nexus with him. He is neither a citizen of our country, neither a resident of this country, does not earn an income. So we cannot tax him. But tomorrow, let us say this American comes and starts working in India. He sets up a business in India. Then now he starts earning an income in India. So therefore the government of India now establishes a nexus with the income. So therefore we can tax that income. So primarily you will understand that an income tax is imposed on two bases. Are you a resident of a country or do you earn the income in that country? Or third concept also, do you receive the income in that country? Now because this concept prevails in every country, so situations do arise where an income earned by a person may become liable to be taxed in two or more countries. For example, a person who is a resident of India has a property in London, so he earns the rental income in UK, but he is a resident of India, therefore the Indian government will impose a tax on that, being his residence status being Indian. On the other hand, UK government will also tax him because the income is being earned there. So he becomes liable to be taxed on the same income in two countries. Right? In a typical case, there could be a situation where he becomes liable to be taxed in three countries. Let us say this rent which he earns in UK is being received by his parents in Canada. So Canada also imposes a tax because the income is received there. So if you have a tax rate of 35% in each country, he lands up paying 105% of his income as tax. That is a ridiculous situation. How do I overcome this? Can the Indian government make a law that once an income has been taxed in India, it will not be taxed by any other country? Right? That is not possible because every country has their sovereign rights, every country will make their own law. We cannot make a law which is enforceable by another country. So therefore what we do is we enter into double taxation avoidance agreements. We also call them tax treaties. What are these tax treaties? Right? Tax treaty is primarily an agreement between two countries and it lays down what will happen where the income becomes liable to be taxed in two countries. So we have different rules. According to these rules, we provide a relief to the person who is being taxed in two countries. A simple case could be double taxation agreement between India and UK could provide that any income from a property derived shall be taxable only the country where the property is located. No other country will tax it, or the other country will not tax it. So therefore, if an Indian now earns an income from a property in UK, he is covered by the double taxation agreement. Now he will be liable to pay tax only in UK. So this is how the double taxation agreements prevent a situation of a double taxation. And the principle laid down in our Income Tax Act is also that if we have a treaty with another country, then the provisions of that treaty shall prevail over the Income Tax Act. So treaty has an overriding effect on the income tax. So we will see what are the provisions of that treaty, tax them according to that. Now whenever India enters into a treaty with another country, who will be governed by this? Right? Normally residents of the two contracting states. If India has an agreement with UK, this agreement will cover residents of India, residents of UK. Right? But this is not exactly what happens. Right? Now what has developed is a concept called a treaty shopping. What happens in a treaty shopping? When one person from another country wants to do business in another country, he does not look only at the treaty which that country has with the other country. He will watch all of the treaties which that country has with other countries in the world. Right? Supposing India has a treaty with UK, a company from US wants to do business in India. So they look not only at the treaty which India has with US, they will look at treaty which India has with UK, with Singapore, with Mauritius, and then they will see which treaty gives them the maximum benefit. And then they can route their business through that country. Right? A classical example was the Indo-Mauritius Treaty. It was in a lot of dispute, a lot of arguments were there, it was in controversy. What was the basic controversy regarding the Indo-Mauritius Treaty? See, when India entered into a treaty with Mauritius, Mauritius is a small neighboring country, so we wanted to give them certain incentives. We said that if investment comes from Mauritius, that is if a resident of Mauritius makes any investment in the Indian stock market, there will be no capital gain tax in India. Right? Mauritius was levying the tax, we said let Mauritius levy the tax, we will not tax that in India. So that was the basic term of the agreement. After the treaty was enacted, after the treaty came into force, Mauritius also changed its tax laws and exempted the profit from shares in their country also. Can you realize what is the impact of that? Whenever a resident of Mauritius makes any income from stock market in India, no tax in India, no tax in Mauritius. Very happy situation. But because we were not levying a tax, whether Mauritius levied it or not, we were not concerned. So therefore, we did not mind that, their amendment where they exempted. Now when people throughout the world saw this phenomena, saw this situation, they found it very attractive. And what started happening was that wherever a Japanese fund would like to make investment in India, they would not make the investment directly. They would open a company first in Mauritius, from the Mauritius route their investment into India. Then you can see what no profit in India, no tax in India, no tax in Mauritius. Very happy situation. So all other countries in the world started routing their business of investment through Mauritius, to the extent that even Indians who wanted to invest in the Indian stock market would set up a company in Mauritius, transfer them to Mauritius and then invest from there, because then there was no tax. Was this the intention of the government? Right? This is not the intention of the treaty, but can I prevent that? Again, no. We have a treaty, we have to abide by that. Right? You will appreciate that once there was a rumor that India is going to amend the treaty with Mauritius. What was the impact of that? The stock market suddenly collapsed by about 1,000 points, because a lot of funds would have flown out of the country. So then the finance minister had to go to the parliament, make a statement, we are not going to amend the treaty. Right? So this is the impact of a treaty. This is what I called a concept of a treaty shopping, where people look at treaties which India has with throughout the world, and then they route their business through that country. Right? Now we have to stop this measure. Right? Earlier we were not aware of what was happening, what were the international tax practices. Now you will appreciate in our new tax laws we have started amending the law and started taxing all these companies through whatever means they try to avoid it. You would have also heard of a concept of a tax haven. Right? What exactly is a tax haven? Tax haven is a small country, maybe an island, having a population maybe of lakh, 2 lakh, 3 lakh people, where they do not have a system of taxation. There are no taxes. Moreover, they have laws of secrecy. Whatever business you do in that country, whatever bank accounts you have in that country, those are not disclosed to any other authority. Right? So again, lot of multinational companies, lot of companies which do not want to pay tax start going to those countries for setting up their business. A very interesting case which came up was the Vodafone case. In case of Vodafone, what happened? There was a company, Hutchison, which was working in India in the telecom sector. This company was incorporated in Cayman Island. Cayman Island is again a tax haven. It's a very small country. Now they wanted to sell their business to Vodafone. They owned a lot of property in India. They owned a lot of assets in India, which had to be transferred to Vodafone. Instead of transferring the assets, the deal that they made with Vodafone was that they would sell the shares of their company to Vodafone. So Vodafone would become the virtual owner of the company, thereby become the owner of the assets also. So this transaction for sale of the shares took place not in India, took place in the country called Cayman Island. Now their argument was that we are transferring the assets outside India, we are receiving the consideration outside India, so nothing has happened in India, there is no tax liability in India. Right, so the matter travelled to the Supreme Court also. Supreme Court also held that we cannot tax this transaction in India. Subsequently, we had to amend the law. We amended the law, and the provision regarding income deemed to be earned in India, now provision says any income from the transfer of assets directly or indirectly shall be deemed to have accrued in India. So therefore, as the situation arises, the law keeps changing. One or two recent concepts that I want to introduce again. To tax a multinational firm doing business in India, we introduced this concept of a transfer pricing. The concept of transfer pricing says wherever there is a transaction between two associated concerns, one of which is an international company, then the transaction has to be at an arm's length price. Right? Let me explain the basics of this. See, if I have a company in India which has different, let us say, profit centers, one unit manufactures certain things, supplies it to another unit of the same company. That second unit does some work on it, transfers it to the third unit of the same company. How much profit is to be attributed to each unit may be a matter of debate. One unit may show higher profit, other unit may show lower profit, but because they are part of the same company, all profit is to be taxed in India does not make a difference to us. Which company shows how much profit does not make a difference to us. But please appreciate that if these units were in different countries, what is the business model that we have today in our country, or worldwide? What is the concept of the business? Now business is not restricted to one country. One company may be having a manufacturing unit in China, they have a warehouse in Hong Kong, marketing in Singapore, research unit in India, all engaged in the same business, but transferring their products from one to another, transferring their services from one unit to another unit. And each unit has to declare a profit. Which unit declares how much profit now becomes material, because one unit has to pay tax in China, another has to pay tax in let us say Hong Kong, another in Singapore, and so on. What would be the attempt of the company? Their attempt is to pay the maximum or show the maximum profit wherever the tax rate is lowest, or even where there is no tax. So in that way they try to manipulate their profit, showing the maximum profit in a country where they do not pay or pay a very little tax. Now this situation is not acceptable to the other countries. When India also realized that this is what is happening with us, that no profit by these multinational companies or a very low profit is being shown in India, then we introduced the concept of the transfer pricing. Now transfer pricing says that if a company of US is selling any product to their unit in India, that has to be at the market value. If it is not at the market value, then we will calculate the market value, difference will be deemed to be your income. Right? Take an example, a US company manufacturing computers, their cost of a computer is 20,000 rupees and their ultimate selling price in India is, let us say, 50,000 rupees. So there is a margin of 30,000 rupees per computer. Where would they show this profit? If they are showing maximum profit in their country, they say that we are selling the computer to our Indian counterpart at 40,000. So in India they would show only 10,000, 20,000 they would show in their own country. Now the transfer pricing regulation says we will compute the market value of this transaction. What is the market value of the computer? Is it 40,000 rupees? If that market value is only 25,000 rupees, that means you have shown excess cost in India by 15,000. This 15,000 becomes your profit, on which you will have to pay tax in India. So these are transfer pricing adjustments that we make. There is a whole lot of things to be discussed under transfer pricing. I just wanted to introduce the topic to you, that this is what happens in a transfer pricing. We have a mechanism, we have transfer pricing officers, we have audits for this, and we have data according to which we compute the market value. So this is one of the aspects that is happening. Then recently you would have heard we introduced another tax which is called an equalization levy. It is also known as a Google tax. Why do we call it a Google tax? Because primary object was to cover companies like Google who are doing business in India, earning income from business in India, but not declaring any income in India. See, how does the Google operate? How does the Google operate? Right? They say we have our servers in a country which again is a tax haven. Their offices are in a country which is a tax haven. So they are operating from there. In India they may not have any office here. Right? You know how Google operates, is basically a satellite based company. That satellite is not in India, but are they earning revenue from India? Right? Certainly they earn a lot of revenue from advertisements which have been collected in India. The revenue has been collected in India, but they were not paying any tax. Primarily they are not residents, they are non-residents here, and their claim is that our income is being earned in another country. We are not earning any income in India. So therefore they were not paying a tax. So then we introduced this concept of an equalization levy. This equalization levy says any person who pays any amount to Google shall pay 6% tax to the government. right. So, indirectly we have taxed that company, right. So, responsibility is to pay tax is not on Google, but is on the person in India who is making any payment to Google, right. So, indirectly the costing of Google will increase and they will have to reduce their prices in order to compensate them for the tax. So, this is another concept which was introduced primarily to cover companies which are not actually operating in India. Physically they may have no place of business in India. Then the way in which the companies in India are being financed. See, if an American company wants to open a subsidiary company in India, they have to finance the activities in India. How much capital would they throw in? Right? As you know, there are two basic ways of financing. It could be either equity or it could be through debts. If you introduce your capital by way of debt, the interest is tax deductible, whereas dividends that you pay are not tax deductible. So, therefore, the effort of these foreign companies is to introduce the maximum capital through debt financing, and they charge a heavy amount of interest on the loans that they have given to the Indian concerns, so that the Indian concern is left with hardly any profit in India. Right? You will appreciate that whatever the profit they make, that is distributed to the foreign company by way of interest on the loan. So, they are doing business in India, earning income in India, but at the same time not declaring any profit because of the interest burden. So, money is also being repatriated to their parents' company, right. Money goes out of the country without India getting any tax. So, now we introduce this concept of a thin capitalization, that for companies who are associated concerns, the capital that they introduce, maximum debt financing can be up to 30%. If the debt component is more than 30%, the interest on that shall be disallowed. Right. So, now by this concept there will be more capital inflow rather than debt coming into the country. So, that way the Indian government will be able to collect more revenue from these companies. Right. Then when I was talking about transfer pricing adjustment, we said that whatever is the difference between market value and the actual transaction value, that is deemed to be the income of that person. Now, on that they pay the tax in here, but again one question remains, is that income actually coming to India? Right? That income does not come into India, although they have paid the tax on that in India. So, therefore, we also introduced a concept called a secondary adjustment. Primary adjustment we make when you sell the goods or when you buy the goods from India, then we add the difference here. If that difference is not brought into India within a specified time, then we start charging interest. We say you have kept that money outside India, you would have earned a certain amount of interest on that. So, that interest also keeps adding to your income year after year until the time that you bring that into India. Right. So, here we have introduced all these concepts because all multinational companies, major part of the international companies, multinational companies were not paying the due tax in India. So, all these concepts have now been developed, and you will see that through these concepts the tax which the government will collect from the multinational companies is going to increase phenomenally. Right. So, that is what was required. See, we keep on taxing our own citizens, our own persons, but there is a limitation on how much tax can be collected from them. And these companies, which are huge multinational giants, were doing business, taking income from here, not paying tax here. So, therefore, these companies have to be brought into the tax net, and therefore, we have made all these amendments in the international taxation in India. These are the concepts that I wanted to introduce you. I hope it makes sense to you as to why we should concentrate more on international taxation, international collection of the revenue. That is a major source of revenue for the government. Thank you, friends.